Have you ever watched a stock soar and felt that irresistible urge to jump in, terrified of missing out? Or felt a wave of panic when everyone else started selling, compelling you to do the same? That powerful force is herd psychology, and it rules the market far more than any spreadsheet or financial report. Welcome to the Economy Unpacked daily YouTube channel. From Wall Street to your street, we share the world of money in a clear way. Today, we're unpacking why investors follow the crowd and how you can avoid getting trampled. Markets are not the cold, rational machines we imagine them to be. They are battlegrounds of human emotion. Investors, both big and small, often make decisions driven by fear, greed, and the magnetic pull of social influence, not just fundamentals. While professional investors might have access to sophisticated data and risk management tools, they are not immune to the siren song of market sentiment. Retail investors, on the other hand, are even more susceptible, often swayed by trending stocks on social media, online hype, and the simple desire to be part of the winning team. In our hyper-connected world, platforms like TikTok, Reddit, and X have become massive accelerators for this herd mentality. Viral posts, memes, and influencer recommendations can create astonishingly rapid stampedes into or out of a stock, often completely detached from its underlying value. This is what fuels both meteoric buying frenzies and devastating panic selling. So, what exactly is herd psychology? In the world of behavioral finance, it's the tendency for individuals to mimic the actions of a larger group, often ignoring their own research or objective data. This isn't just a financial quirk. It's a deeply ingrained human instinct. Biologically, we are programmed to follow the group. For our ancestors, straying from the tribe could mean death, so sticking with the majority felt safe. This safety in numbers principle is a powerful evolutionary echo that still resonates in modern financial markets. When we see a crowd of investors rushing to buy a particular stock, our ancient survival instincts kick in, whispering that the group must know something we don't. This is why herding feels so reassuring, providing psychological comfort even when the market's direction is completely irrational. It reduces the stress of making a decision alone, even if that decision ultimately leads to financial harm. This herd behavior is fueled by several powerful psychological biases. First and foremost is FOMO, the fear of missing out. This is the anxiety that drives investors to pile into a stock at dangerously high prices, purely because everyone else is getting rich. The opposite of this is loss aversion, a bias where the pain of losing money feels twice as powerful as the pleasure of gaining an equal amount. This causes investors to sell in a panic at the first sign of a downturn, locking in losses instead of weathering the storm. Then there's social proof, the assumption that the actions of others reflect the correct behavior. When we see a multitude of people buying, it validates the decision in our minds, making it seem like the right thing to do. This is reinforced by confirmation bias, where we actively seek out news, articles, and social media posts that confirm the crowd's narrative. Filtering out any dissenting information, finally, overconfidence bias can set in, leading us to believe that a crowd of thousands simply cannot be wrong. This collective confidence encourages exaggerated risk-taking and dangerous overexposure to a single hyped-up asset. These biases work together to shape major market trends. The most common effect is trend-following behavior. Crowds amplify price momentum, meaning stocks go up simply because people see others buying, which in turn attracts more buyers in a self-perpetuating cycle. When this herding becomes extreme, it inflates asset prices far beyond their fundamental value, creating speculative bubbles like the dot-com boom or the pre-2008 housing market. The inevitable pop is just as dramatic. When fear replaces greed, everyone rushes for the exit at once, creating sudden and sharp market crashes. This herd mentality can also fuel momentum rallies that completely ignore a company's actual performance, leading to extreme volatility. Worse, this group behavior can be exploited. Pump and dump schemes are a classic example, where manipulators artificially inflate a stock's price and then sell off their holdings to the unsuspecting herd that followed them in. History is littered with case studies of herd psychology in action. The GameStop and AMC short squeeze is a perfect modern example. Coordinated buying among retail investors on Reddit's Wall Street Bets forum caused these stocks to surge to astronomical prices, demonstrating how social media can organize a herd and create price swings completely disconnected from business fundamentals. Looking back, the dot-com bubble of the late 1990s saw investors pour money into any company with a com in its name, driven by hype and FOMO, only to face a massive crash when the inflated valuations met reality. Similarly, the 2008 financial crisis was amplified by herd behavior in the housing market. Banks, lenders, and investors collectively misjudged the risk of subprime mortgages, all following the belief that housing prices would only go up. And of course, there's the world of cryptocurrency. The spectacular booms and devastating crashes of assets like Bitcoin and Dogecoin are often driven by online hype and social media trends rather than any discernible fundamental value. This isn't limited to the US. Housing booms in Canada, the UK, and Australia, and surges in commodity investments have also been fueled by mass investor sentiment rather than underlying supply and demand. The science behind why we follow the crowd is fascinating. From a neurological perspective, our brains are wired to reward social conformity. When we do what others are doing, our brain releases dopamine, the feel-good chemical, creating a sense of pleasure and validation. Behavioral economics explains that herding is a mental shortcut to reduce perceived risk. If a decision turns out to be wrong, the psychological blow is softened by the fact that everyone else made the same mistake. It's an ancient survival mechanism rooted in managing uncertainty, now misapplied to complex financial decisions. This instinct is magnified by modern media and online echo chambers. Financial news channels, forums, and social media algorithms create powerful feedback loops, where a single idea or sentiment is repeated and amplified until it feels like an undeniable truth, making the herd effect more powerful than ever. The dangers of blindly following the herd are immense. Investors who succumb to FOMO often enter a rally too late, buying at the peak just as the early investors are cashing out, exposing them to immediate and significant losses. Conversely, those who sell in a panic during a market downturn often exit too late, locking in their losses right before a potential recovery. This emotional decision-making means they get trapped in bubbles, watch their portfolios deflate, and miss out on long-term opportunities for growth. Ultimately, following the herd means abandoning your own investment plan. A rational, rules-based strategy is the bedrock of successful investing, and herd mentality directly violates that principle by replacing logic with emotion. So, how can you protect yourself from this powerful psychological force? The first step is to build a rules-based investing framework. Create a checklist for evaluating stocks based on logic and fundamentals, not social sentiment. This forces you to be disciplined and objective. Diversification is your best defense against overexposure to a single crowded trade. By spreading your investments across different assets and sectors, you insulate yourself from the collapse of any one bubble. It is crucial to focus on the long-term value and underlying fundamentals of a company, not its short-term price movements. Tools like stop-loss orders can also be invaluable, as they create an automatic exit plan that prevents you from making rash, fear-driven decisions during a market panic. Perhaps most importantly, learn to recognize the early signals of herd behavior, extreme price moves on high volume, universal positive sentiment, and talk of a new paradigm. By identifying these signs, you can anticipate market extremes and avoid getting swept away. It's also worth studying contrarian strategies, which are built on the principle of going against the crowd, buying when others are fearful and selling when others are greedy. Interestingly, professional investors don't just protect themselves from herd behavior. They actively seek to exploit it. They understand that mass panic and euphoria create market inefficiencies and, therefore, opportunities. The classic Warren Buffett principle is to be fearful when others are greedy and greedy when others are fearful. This means buying quality assets when they are undervalued due to widespread panic. Conversely, smart investors sell into euphoria, locking in profits when an irrational crowd drives prices to unsustainable highs. Emotional overreactions often create predictable turning points in the market that can be identified and acted upon. Technical indicators, like the Relative Strength Index, RSI, which measures overbought or oversold conditions, and volume spikes can help reveal the intensity of herd-driven momentum. By understanding the predictable patterns of institutional versus retail behavior, professionals can often position themselves to profit from the crowd's emotional swings. In the end, mastering the market is less about technical skill and more about mastering yourself. True investing success is arguably 80% psychological control and 20% strategy. Understanding the mechanics of herd behavior is the key to both avoiding devastating losses and finding the rare opportunities that others miss in their emotional frenzy. The ultimate takeaway is this: to outperform the market, you must learn to think independently, act rationally, and tune out the distracting noise of the crowd. Thank you for joining us on Economy Unpacked Daily. If you found this analysis helpful, please hit the like button, subscribe to our channel, and ring the bell for more insights that help you navigate the world of money. We'll see you in the next video.